Natural language processing for stock news. Natural language processing, or NLP, is one of the most exciting innovations in investing today. It allows algorithms to read, analyze, and interpret human language, which means investors can quickly process earnings reports, news articles, SEC filings, analyst notes, and social media posts to gain insights about stocks and market trends. In theory, NLP gives investors a huge advantage: the ability to react faster to news, identify sentiment shifts, and make informed decisions based on real-time data. However, while NLP can be a powerful tool, many investors make critical mistakes when relying on it, and these mistakes can cost money, opportunities, and confidence. In this video, we're going to break down the most common mistakes investors make when using NLP for stock news and explain how to avoid them. One of the biggest mistakes investors make is overreliance on NLP outputs without understanding the context. NLP algorithms are designed to analyze text and detect sentiment or key information, but they don't inherently understand the nuances of human language. For example, sarcasm, irony, or complex financial jargon can easily confuse an algorithm. If an investor relies solely on NLP sentiment scores from a news article or tweet, they might misinterpret the market's signal. A news headline that seems negative might be neutral or even positive when analyzed in context, and NLP tools can misread it. Investors must remember that NLP is a tool to assist decision-making, not a substitute for critical thinking and context analysis. Another common mistake is failing to verify the data sources feeding the NLP system. Investors often use automated platforms that scrape news from multiple outlets, social media, or press releases. While this provides speed and scale, it can also introduce errors or bias. Not all sources are reliable, and some may intentionally or unintentionally present misleading information. If an NLP model analyzes low-quality or biased data, it will generate flawed insights. Many investors assume that AI is inherently accurate, but it is only as good as the data it's trained on. Cross-referencing news, checking source credibility, and combining NLP insights with traditional research are essential steps to avoid costly mistakes. Investors also frequently ignore the limitations of sentiment analysis, which is one of the most common NLP applications in finance. Sentiment analysis assigns a positive, negative, or neutral score to text based on the language used. However, financial news is complex, and not all negative words mean negative outcomes. For instance, a report stating that a company missed revenue expectations but exceeded profit forecasts contains both negative and positive elements. A naive NLP model might interpret this as negative sentiment, triggering a misguided trading decision. Investors who rely purely on sentiment scores without understanding the nuances of the underlying information risk overreacting to partial or misleading signals. Timing is another area where investors make mistakes using NLP. Just because an algorithm flags a piece of news or detects a sentiment shift doesn't mean immediate action is always appropriate. Markets may already have priced in the news, or additional context may emerge that changes the interpretation of the initial report. Overreacting to NLP signals can lead to unnecessary trades, increased transaction costs, and worse performance over time. Successful investors use NLP as part of a broader strategy that includes market analysis, trend assessment, and risk management, rather than treating it as an instant trigger for buying or selling. Investors also sometimes overfit NLP models to historical data. Overfitting occurs when a model performs well on past examples, but fails to generalize to new or unseen data. Many retail investors, and even professionals, make the mistake of trusting NLP models that were tuned too specifically to historical news and stock reactions. The result is that the model may predict past patterns accurately, but fail in real-world scenarios where language, market dynamics, and investor behavior are constantly changing. Continually retraining models with fresh data and testing them across multiple scenarios is essential to avoid this mistake. Another frequent error is ignoring the role of alternative data and integrating NLP insights improperly. Modern investors increasingly combine NLP with alternative data sources such as earnings call transcripts, web traffic, sentiment from social media platforms, and even supply chain reports. If NLP signals from one source are taken in isolation without cross-validation, the results can be misleading. For example, a surge of positive social media posts about a company may reflect hype rather than actual financial performance. Investors must combine NLP insights with traditional financial metrics, technical analyses, and broader market indicators to make balanced decisions. Misinterpreting NLP probability scores is also a critical mistake. Many NLP systems provide probabilistic outputs, indicating the likelihood that a piece of text is positive, negative, or neutral. Investors often treat these probabilities as certainties, making trading decisions as if the outcome is guaranteed. In reality, NLP outputs are statistical predictions, not definitive truths. Treating them as absolute can lead to overconfidence, excessive risk-taking, and portfolio volatility. Smart investors use NLP probabilities as signals rather than definitive instructions, incorporating them into a risk-managed decision-making process. Another area where mistakes happen is neglecting regulatory and ethical considerations. Some investors use NLP to monitor social media sentiment or forums for potential insider information or market-moving rumors. While these insights may appear valuable, acting on unverified or confidential information can raise legal risks. NLP is a tool for improving information processing, not a way to circumvent regulations. Investors must always comply with SEC guidelines, trading laws, and ethical standards when using AI-driven analysis. Finally, a common mistake is ignoring the need for human oversight. Even sophisticated NLP systems are not infallible. They can misinterpret language, misclassify sentiment, or fail to recognize emerging trends that fall outside historical patterns. Investors who blindly follow NLP recommendations without human review risk making serious errors. The most successful use of NLP in investing combines the speed and scalability of AI with human judgment, critical thinking, and strategic oversight. To summarize, NLP offers incredible advantages for processing stock news and financial data at scale. But investors need to be aware of the pitfalls: overreliance on algorithmic outputs, ignoring context, poor data quality, misinterpreting sentiment scores, overfitting models, reacting too quickly, and neglecting human oversight are all mistakes that can undermine performance. Understanding these challenges and integrating NLP responsibly into your trading or investment strategy is key to gaining the real benefits of AI in finance. If you find this video helpful, make sure to subscribe to our channel for more content on personal finance, investing strategies, finance, and practical tips for U.S. investors. Like this video to help others learn about the risks and opportunities of NLP in investing. Leave a comment sharing your experiences or questions, and share it with friends or family members who are serious about smarter, data-driven investing. By combining AI tools like NLP with critical thinking, risk management, and traditional research, you can improve your investment decisions and navigate the stock market with greater confidence.